Hello and welcome to FTSE Funds and Finance, episode 10, the Straight Talking podcast brought to you by Goodwin Financial Services. I'm joined once again by financial advisors Steve Goodwin and Josh Goodwin. How are we doing, gentlemen?
All good, thank you. All good. But before we start, I think we need to congratulate you on becoming a mortgage and protection advisor, the first step towards qualification. So Kev's on the way, and next 12, 18 months, hopefully he'll become, all things being well, become a fully fledged financial advisor.
We're getting there. Thank you very much. Yeah, it's very pleased. So we're on our way. We're on our way. But talking of on our way, we this podcast today is predominantly talking about predictions of what we see for 2023. We did one back at the beginning part of last year when we made some certain predictions that we'll come on to a little bit later on. The main things we're going to focus on this one for the predictions 2023 is the global markets, the world stock markets, what we expect or think might happen and the reasons behind that, and then also interest rates as well, but just in the UK, kind of focusing on what we think the interest rates are going to do over the course of the year. 2022 was a very interesting year, lots of ups and downs, lots of downs and then a bit of up. What do we see, do we think the markets over the next year, to start off with the stock markets first of all, across globally?
Well, a lot of what we think was encompassed in our 2022 predictions, because some of them fall across to 2023. And what we said in 2022 was we thought that the markets would be very rocky for 9 months, then bottom out. And then we thought that the bottoming of the market would be end of September, and we thought we would then get a positive stance, and exactly that is how it played out. I mean, I think you've got the stats, haven't you, in the numbers?
Yeah, exactly. Your predictions, as you said, Steve, as the beginning of the year was we thought it was going to be a rocky start to the year. It ended up being very rocky.
Even more rocky than I think we thought.
Even more rocky than we thought, but that was definitely rocky for the first part of the year, certainly for the first 9 months. Then come towards the end of October.
So end of September.
Beginning of October is when the market started to pick up. And one of the things that we spoke about as well off air is at the beginning of October, that's when you thought that the market had bottomed out, and you emailed the client saying this is a good time to invest, despite the falls. This seemed to be good, and it proved to be quite right. The Dow Jones since October is up 17.53%. The FTSE since then is up 12.73%. Now, of course, the drop was bigger than that, but the predictions you made, the both pair of you made over that 9 months, tended to be right. So going into 2023, what do we think now the markets are going to do going into this to 2023? And importantly, one of the things that it contributed to the rockiness this year, to the war, was the inflation. Inflation was the big thing we talked about all the time. What do we think for inflation this year and last year, Josh? What do you think about inflation is going to happen?
We've already started to see some of the outcomes of the fiscal policies of the central banks. Since about the summer, the stuff that goes into making goods that is not in the inflationary basket have already started to come down. However, we haven't seen that filter through just yet. But what a lot of people don't realise is the changes in costs, prices, and the pressures interest rate rises put on. It doesn't show overnight. It takes a while to filter through the economy.
Yeah,
it's not an overnight thing. That's why predictions are constantly changing of what's going to happen. But we are seeing inflation starting to slow down in the products that produce our goods, which means eventually, hopefully soon, that those prices should start slowing down for everyone. So that's a good sign. Hopefully we'll start to see inflation pressures ease over the next 6 to 12 months.
And the working case for that, a little bit off left field here, but that delay that you talk about was very much like we heard in COVID, wasn't it? When they brought in measures, obviously flatten this curve, and there was that delay before the data come through, and that's very much similar with the inflation.
Yeah, that's a really good comparison. That's a good way to think about it, to be fair.
Yeah, so what do we think then for 2023? Obviously, as Josh said about the inflation, we're starting to see some of that. We haven't seen the effects of that. What do we think on the global markets for the rest of 2023?
I have no reason to change my own opinion. Obviously, we can be wrong.
Sure.
But my opinion is very much the same. And too many people, when they look at markets, concentrate on FTSE. You'll talk to a client. I'll talk to a client on review, and they'll go, "Oh, yeah, I've been following the FTSE." but they're following something that's not that relevant to their portfolio, because the portfolio is mainly, most people's portfolio would primarily not have the UK as a dominant force.
Sure.
And it's the US market that is a dominant force around the world. So when we look at markets, I tend to look at the US for my guide, because you're not going to see a massively rising UK market in a big falling US market.
Sure.
And it all comes back to the US presidency and the third year of the American presidency. Historically, from October in the second year until September in the third year is the honey period.
Yeah.
It has been the honey period for 100 years.
Yeah.
And it's a honey period because everything stagnates. The Congress is paralyzed, nobody can do anything, and therefore businesses and everybody else can plan ahead. And markets therefore tend to rise during that period. And as I've said before, and I know I'm boring some people that watch this all the time, in the third year of an American presidency, only 1 year in the last 100 has the market fallen, and that was 1939, Second World War, and then it fell less than 0.1% in the whole year. Now, what is also quite interesting, and I always say that third year of an American presidency is a good year, the average return of the US stock market in the third year of an American presidency, when the market falls in the second year, is 30%.
Okay.
It's humongous. And we are in that cycle. Now, things you can argue a little bit different, and you've got the prophets of doom that I don't listen to, because they love it. They just love to tell us how bad things are. But all the signs of history are currently repeating. And that means that sooner or later, if we are right, these prophets of doom will just capitulate and run back into the cracks in the wall that they come from, and you will get market conditions resuming. Now, of course, we're in rocky world times with the war going on, and if there's a nuclear war or China invades Taiwan, there are things out there that can affect this. But barring any further bad news to come, I do not see any reason why this next 9 months will not be a good period. And so therefore, by having the good 9 months, we're going to have a good year. So I'm predicting 2023, as I predicted in 22, will be a good year.
Yep.
Just to give you some quick stats, and we're recording this on the 1st of February.
Yep.
So far this year, the Dow's up 2.83%. The FTSE, for your interest, is up 1.95%.
Yep.
So it's already started in positive territory. And I think on the balance of probability, with the way the market has fallen last year, with the fact this is a third year in American election, with the fact the American market are paralysed, and as Josh said, inflation is so much more under control than people are admitting, than the banks are admitting. We've covered this on previous podcasts. Inflation is going to come down relatively quickly. And we'll come on to this in interest rates, but I do not see any reason why this won't be a positive year. And I'm very positive on this year. And for clients, I'm positive. The clients that have been bold and that have invested from the October upwards have yielded really good rewards. But I do understand that psychologically it's difficult to be bold for clients in where they've seen a bad year.
Yeah.
But it is the right time. It's the right time to buy property when it falls. It's the right time to buy markets when you think they're at the bottom. And markets you should buy any time, but there are sometimes when it's bottomed, an even better time to buy.
Yeah.
So predictions for 2023, I expect markets, when we do the end of the year, I expect us to have a positive year. I expect our clients to earn good money. They're in the right funds, and I just expect it to be a very good year, just as last year wasn't so good, although we recovered a little bit in the back end 3 months.
Yeah, bar, like you say, any disasters, anything out of left field that we...
Yeah, exactly. And nobody can predict that.
No, absolutely. And one of the things you mentioned about there is interest rates. That was a hot topic this year. Interest rates went up, mortgage rates rocketed off the back of that. I don't think some of those mortgage interest rates have bitten yet. People still on very low interest rates if they're on fixed terms. That will be coming up this year, and that will be interesting to see. I think people will start to see some of that effects this year.
That's going to carry on for the next 2 to 3 years. People still going to be on lower fixed rates. However, I know it's not part of the subject today, but interest rates have fallen since they did peak last year in terms of what people receive from lenders. Lenders actually continually drop rates, which is an actual good sign. It has eased some pressures on people.
Yeah, exactly. That's like you say, the interest rates have started to come down, haven't they? The mortgage rates, and although, like you say, there will be some people on fixed terms that are changing that are on a lower interest rate, so it will still be higher for them. So it's a bit of a mixture this year, isn't it?
Yeah, no, it is, but just the rate some people were looking they were going to have to pay towards the back end of last year in terms of mortgage rates has dropped quite considerably.
And I remember one of the seminars we were on as well, one of the things they're talking about is interest rates they thought were really going to rocket towards back end, and it never actually got to that point that was that
But
high.
what did we say? We said that wasn't true.
Yeah, we thought they were over.
We thought it was wrong. I mean, the doomsters, the gloomsters were predicting 6% interest rates. And even if you went to seminars with economists, they were predicting it. But it made no sense. And it still doesn't make any sense that that's going to happen. And we predicted that wouldn't happen. And they're not going to hit anywhere near 6%. We'll come on to that in a minute, in my opinion, or our opinion. And so what's happening now is lenders, as Josh is dealing with all the time, lenders are pricing more competitively. Not only fixed rates, but there's also tracker rates are really back into the mix now. And we wrote an article on that in our newsletter for clients on Saturday. So for our clients, if you haven't read that and you want to know about it, look at last week's newsletter.
Yeah.
And there's a whole topic about fixed rates and tracker rates and on the advantages and why things are changing. But yeah, that's so. I mean, Josh, you deal with this day to day. You're the mortgage king. So, what's your view on interest?
Let's talk about the interest rates. The predictions for the UK, as we said last year, they rocketed up. What do we think for 2020? Do we think we're at the top of the interest rates in terms of the Bank of England interest rate, or do we think there's going to see more rises?
There's going to be a few more rises, yeah. I think they might slow them down a tad. But I think the last couple of times we've had 0.5%. Maybe we'll go back to a quarter. But I think we're not at the peak yet. The Bank of England have quite openly pretty much said that.
And for people not knowing, why would they be increasing interest rates? Is obviously to try and slow this inflation.
Trying to slow this inflation. Once you start getting good news that inflation starts to slow down, the Bank of England should then start to slow down. I don't think the Bank of England say things, but I'm not sure they really know what's happening either. No one really does. We can all make predictions.
Yeah, it's hard, isn't it? There's so many variables. There's so many things that can happen. We don't think we've seen the top, Josh, in terms of these interest rates. How much more do you think we might see this year? Where do you think mortgage rates are going to be? What do you think is going to happen?
How long's a piece of string?
Yeah.
It's really hard. I think we've definitely got at least another 0.5% in us.
Yeah.
Minimum, I'd say. After that, I'm not 100% sure. I'd be lying if I said anything else.
Yeah.
I think some of the lenders' rates have been reduced, so they might have to go back up a tad with that. But I think a lot of them would have priced in some of the increases that could potentially be coming at the beginning part of this year.
And that's what happened with the mortgage rates, wasn't it? Well, that's why you're starting to see lenders reduce rates now. They had planned ahead for thinking that the interest rates were going to trying to get ahead of the curve. Obviously, it wasn't as bad as they thought, and then they adjusted slightly.
Sort of. So lenders' interest rate space is I won't bore you or try and go into the technicalities, but basically making it quite simplified. Lenders base their rates on the future swaps of rates. So when this trust came in that budget, they were predicting rates could hit 7%. So at that point, when they were doing long-term interest rates, what lenders fix at, especially, was so sky high. They had no choice but to absolutely hike their mortgage rates.
And now, like you say, because it's changing slightly, they can obviously adjust their rates, but predominantly for this year.
Exactly. The long-term swap rates have reduced quite a lot, allowing lenders then to pass that on to the consumers.
And Steve, what's your predictions again for the interest rates? You agree with Josh?
Right. Well, there's a bank. We got a meeting this week. They'll go up either a quarter or a half.
Yeah.
I think they'll go up a half.
Yeah.
But then they'll
which is what they've done the last 2 or 3
years. But there's a chance they go up a quarter.
Yeah.
I think that I predicted that I think a few months ago, that they would peak when they were talking about 6. I said I didn't believe that they would peak above 4.5. I'm still of that opinion. I don't think that rates will hit 4.5, the Bank of England rates. And that's what makes, when you look at tracker deals now, if you have a look at them, it makes them a little, potentially attractive. And then I also think the rates will fall quicker than people are envisaging. I mean, we could see rates falls before the end of the year, because if inflation comes down as fast as I believe it will, and I think inflation is going to come down, like Josh, I think it's going to come down quite quick, a lot quicker than the people are forecasting. I think the doomsters are predicting it stays.
It also depends on the economic situation of this country.
Sure.
Obviously, the IMF came out and didn't give a great forecast.
Sure.
But that makes it more likely that we reduce interest rates. So when the IMF have said the UK is in real trouble, in the worst economy, well, they have to reduce rates faster.
Yeah.
If that's the case, we have to get rates down. So that's another advocate. And again, as Josh said, you're predicting things, and it's a never-moving market. But as we sit here today, with no big changes, and we can only say it as we see it today, I think as far as the UK is concerned, that the rates will come down quicker because they have to.
Yeah.
And I think we could see rates reducing this year. So the issue that people have when they're fixing, they get the security of fixing rates, but they might feel a tad disappointed if rates peak at 4.3 or something like that, and then start falling, because the fixed rates at the moment tend to be trading at around the 4.5 mark. And if you tracker it and the rates then come down, you're going to be feeling a bit sick. So it's difficult because you're exchanging certainty for possibly a worse end case scenario.
And that's why you have advice, isn't it? Because different scenarios suit different people, and that's why it's important you go and get professional advice for your mortgage or finances, because they'll be able to look at your situation and explain to you, what's the best situation for yourself. Talking about inflation, obviously we expect inflation to come down quite faster than we predicted, but do we still think inflation will be higher? Normally the government target is around 2%. Do we still expect inflation this year, although we expect it to come down? Obviously this year it's been up 10%, up in high, or the double figures. Do we still think it's going to be higher than normal this year?
Yes, it's not going to be like a plane crash where it just comes absolutely down to the floor. It's going to be a steady decline over the next 12 to 18 months, maybe 2 years. And maybe a bit after that, you might see the return to the 2%. I think that's a fair assumption.
Yeah, I think it will come down. Inflation this year will come down fast.
Yeah.
But when I say come down fast, what we're saying is it's not going to come down to 2%.
Sure, exactly. That's what
but it's going to come down. The Rishi Sunak prediction, I'm going to halve inflation. I say Mickey Mouse could be in charge of the country and inflation's going to halve, because
he must be next in line. Everyone else has had a go.
Yeah. So, it's ridiculous what he's claiming, because it's going to happen anyway.
Sure.
So inflation will come down probably quite quickly in the UK to 4 to 5%. And then it's a push down from there. It's like losing weight, inflation. Mm-hmm. You lose weight quite quickly early on.
Yeah.
And then it stabilises. It's hard to get the rest of the weight off.
Yeah.
And that's going to be the case for inflation. I think compare inflation with a diet, and you're probably... That's the way to look at it.
But then you're counterbalancing your argument. They can't drop drop interest rates if inflation isn't falling, because the Bank of England's main job is to control inflation.
But they'll drop it. But when inflation comes, say, from 10 to 5 to 4, rates can come down at that point, because they can drop rates if the economy is not going to boom.
Sure.
And if the IMF is right and it says that the UK is in such a mess, if that is true, then by dropping interest rates, it's not going to cause inflation. Mm-hmm. So that's what I'm saying. The IMF is going to do that. That's why I believe we get down to 4 to 5. That's why I believe rates start to come down. I'm not saying they're going to drop hugely, and they're not going to get anywhere near to the people's rates at the moment.
Yep.
And then it's going to stick, and then it's going to be a balancing act. But the initial surge is going to be like the weight loss.
Yeah.
And then it's going to hang, and then markets will determine it.
Okay, well, that's the predictions for 2023. As always, if you are looking for financial advice, whether it's pensions, whether it's investments, obviously mortgages, please get in contact with one of the guys here. Just a caveat is Goodwin Financial Services is authorised and regulated by the Financial Conduct Authority. Gentlemen, thank you very much, and we'll catch you again next week.